Hello, I'm Robert and welcome to my channel where I discuss everything automated algorithmic trading or simply algo trading. Today is going to be a bit of a busy video, so let's get straight to it. This is going to be a bit of a spoiler alert as well. What you're looking at on the screen is version 2 of my Oanda GridBot going through testing. And I do mean extreme testing. You're looking at the process where I am testing with a take profit of only 1.5 to 3.0 pips. And as you can see, the profit values are extremely small. But in the 3 days that I've started this, it has taken in roughly 750 completed trades, earning $33. Now this is a demo account, but this demo account does take into account financing rates, financing fees, so forth. So these profits are legitimate as if it was a real market. And we're going to go through and look at those profits in detail. But I wanted to talk about something more specific that this research has opened my eyes to. You see, I've started working with GridBots 4 years ago. I loved the ideal of never having to worry about the direction of the market and having a GridBot just be able to work all the time. I tried hundreds, if not thousands, of different implementations. Some worked for a short period of time. Most were complete failures. So 2 years ago, I started researching and writing my own versions. And last year, I put my first prototype online. And it's making money. In fact, I'm still using version 1 as I test version 2. But the emphasis of testing that I wanted to really find out, and that is, what would happen if I put this in an extreme condition? If I just open it up and really let it do stupid stuff? Was the grid trading technique so toxic that every single major investor says it is? That's the question I really wanted to get to. Every major institutional investor, every major professional trader always says grid trading fails. Why? I needed the answer to that question because my own research has shown that with proper research, proper risk management, proper budget management, and proper analysis, it's very profitable. You see, realistically, any trading technique that is not properly tested and vetted is a failure. But when you look at prop firms or certain investing institutions, they come out and say that explicitly grid trading is forbidden. Now they can do that since it's their money that you are using in the prop firm. But why is it forbidden? It's not like they care if you lose your money, because they don't. They don't care at all. And that's the problem. It's not about protecting you from losing your money. There's something more nefarious going on in this entire process. And that is what I wanted to find out. What is so bad about grid trading that there are even legal jurisdictions that have imposed a first in, first out regulation to try to stop you from using grid trading. You see, grid trading is a principle of breaking up the chart or the information you're given in the basis of steps or grids. For example, if you have a stock, let's call it Widgets Incorporated. If it has a $100 value, well, if you divide that value to 100 steps, each step is $1. So as the price fluctuates up and down $1, you can make money. But because of the way the first in, first out regulation works, you can't sell identically sized positions without selling the oldest one first. And the oldest one is always going to be in a loss. So here you have a government embodiment deliberately trying to keep you from using a grid trading technique. Why? And that why is very simple. That why is what I'm going to demonstrate here and now with 750 trades since Monday. That why is because grid trading, when properly set up and researched, makes money at an astounding rate. And for the large institutions and banks, large amounts of grid trading would be death by a million profits. You see, grid trading at its basic fundamental understanding takes very tiny profits over the course of the period of time you're waiting. In this case, 3 days, 750 trades. Now I've made $33 with a testing balance of 10,000. Over the course of 1 year, that's a 26% profit. And as you can see, some trades, because of slippage, will come back negative. That's fine. Most trades come back with a small profit. Now this is an extreme case and not something you should do in real life. But it gives you an idea of just how you can push the limits in a realistic and feasible way if you have the money. And as you can see with each profit, some of the profits don't even make 1 penny because of negative slippage. But it doesn't matter, it's still a profit. And the criteria that I used to decide that profit is when the asset's P&L, or profit and loss value, is simply above 0, then it can sell when the sell signal comes in, which is roughly 1.5 to 3 pips, depending upon market movement. Now, for the purposes of this grid, I have 123 steps. And one thing that the biggest mistake that is taught about grid trading is that you should never take losses. See, this is also part of the reason why it gets such a negative viewpoint, because you are being deliberately lied to in order to prevent you from using a technique that has been proven insanely profitable. Any and all trading techniques, sooner or later, must take a loss just because the market moves, the market fluctuates. Your trading technique must move and fluctuate with the market. That's an absolute given no matter what technique you use. So if the market moves, the grids need to move. And that means inherently and critically obviously that at some point there must be a stop loss so that you can maintain the number of grids that you're trading as the market fluctuates. The goal of the stop loss and the goal of the size of your grid is to analyze the market and determine where the market is on an average for its lifespan, and then from there to build your grid around that average so that you are putting yourself in a better position algorithmically to make money over the long term of the market. And as you can see, over and over and over, we have the situations where tiny profits, aggregated profits, even aggregated slippages work in your favor, because a few times that the slippage does hit you is far dwarfed by the number of consistent tiny aggregated profits. Greeded trading is not about making large profits with huge moves. It's about making very small profits continually at large numbers. By focusing on your approach, by focusing on the technique of a properly established grid, you can and will develop over time a high level of consistency, and that consistency will be long-term profitable. Now let's talk about the implementations on the market and why they're built the way they are, because there are reasons that perpetuate the lies and deceptions of why grid trading is bad. Most grid trading is static, meaning you have a fixed lower boundary and a fixed upper boundary. Right there, that is a deliberate and malicious fraud, because it doesn't work with the market as the market moves. If you start the grid at the bottom and then price goes up in your direction, you win. But if you start the grid and price goes down, you lose. And you lose everything you've invested. By not having the grid able to take strategic stop losses, it can't move with the market. That's a deliberate stunt to make sure you can't take advantage of the true property of what grid trading is: micro-aggregated profitability. The other factor to be aware of is a lot of places that give you grid trading techniques force you to use limit orders. That is another gimmick designed to hurt you as a trader. Limit orders don't let you take advantage of compounding, particularly if it is the base side of the currency. So 2 TRX is 2 TRX, or 0.1 BTC. The sizes don't adjust proportional to your budget. For example, in the case I am using here, I have 123 steps. I've calculated my budget, and as you can see, I am using specifics for my order size. My order sizes are not constant because I am taking advantage of all of those macro profits over and over as I build my account, which you can see here for the demo account as the prices continue to change. So you get the idea in terms of how the prices change over time, slowly and consistently. Grid trading is a technique that lets you not worry about what direction the market is going to go. It is a technique that gives you reasonable control of the market as long as you think about a worst case scenario. If you get greedy, if you get impatient, it will ruin you. But so will any trading technique. Grid trading requires patience. It requires you to be willing to commit yourself 6 months to a year to a single asset, and then letting that asset build over time consistently. As you develop your trading styles and techniques, you see which techniques work and which don't. The market perpetuates greedy solutions. Greedy solutions causes loss. Trading is a zero-sum game. In order for you to make a profit, somebody has to make a loss. Grid trading is able to sit there and patiently take small, tiny bites. For large banks and institutions, this is a slow, painful death, as these tiny bites over time have an impact on their profitability. You're winning, they're losing. But when they go in and they do large bulk orders at a specific price, and they're using stop loss harvesting techniques, looking for where people are going to put their stop losses, they're winning, you're losing. 90% of all retail investors lose because they don't understand the fundamental principles of aggregated profits, of being patient, of trading in cyclic markets that go up and down on a regular basis. Or they don't understand that if a market is going to go up over time, no matter what the seasonal market is, like the S&P 500, you don't go against and short those markets, thinking for a long-term plan. Short-term trading techniques are for short circumstances. Grid trading is not a short-term process. It is a long-term process, and you must be dedicated to the duration that you are in the market. Over time, you will profit. Over time, you will succeed. But you're not going to go out and buy a Lamborghini with it. You're not going to get rich overnight. If you have $1,000 budget, you're not going to make $1,000 a month. And that really doesn't matter what technique you use, but that's the kind of rhetoric you see spewed all over the internet, through cryptocurrency exchanges and even some forex brokerages, that grid trading will make you a millionaire quickly. No, it won't. That's not what it's for. Grid trading is slow, consistent, opportunistic approaches. Tiny profits that add up over time. Very, very tiny profits. That is the true nature of a robust, perpetual, or floating grid system. Any platform that offers a grid trading bot that does not give you the ability for the grid to float with the market, meaning when the price moves against you, to be able to take a stop loss and continue moving, is deliberately and maliciously trying to scam you. You cannot use a static trading method in a chaotic market. It just doesn't work. Anybody telling you that you can make a 100% profit with grid trading is trying to scam you. It's not realistic. No trading process will give you a 100% profit rate. Even if you use accumulation, it doesn't matter. Sooner or later, something is going to go wrong and the machine's going to break and you're going to take a loss. Nothing is 100%. So as you see the small micro profits, this one just outright broke even. But nonetheless, here you see slippage. Slippage in fast-moving situations can cause losses. Even in accumulation, this can happen. You're never guaranteed profits. Grid trading doesn't try to guarantee profits. A reasonable and rational approach will guarantee a reasonable and rational long-term profitability. But you are not guaranteed that every single trade is going to be profitable. You are not guaranteed that you're not going to need to take a stop loss. So as we continue looking at how this works, as you can see, over time, the profits build slowly and steadily. And you can see sometimes the amount of time you're in a position isn't that long. 3 minutes, 31 minutes, 2 hours, so forth. Continuing to look at the markets. And you can see where I test and I experiment and I do stupid things. That's what this demo account is about. I tried to break it. I deliberately sold the position midway. So you see here, right here I'm at 10,099. I had an open position. I deliberately manually took the loss. I took a huge hit. Remember, this is a demo account. One of the things I test is what happens if I lose an internet connection. And that is possible, so I've tested it. Now, will this recover? Yes, it does. Slow and steady, it continues increasing. So the technique, if this were a real market and that loss occurred, whether it's a stop loss or doing something stupid and hitting the wrong button on your screen, it doesn't matter. The technique will recover. Another fundamental principle that grid trading gives you above other techniques, and that is it's human resistant. And that's the important part you need to think about as you trade. Not everything goes according to plan. So in my testing, I tried to simulate a bad situation, and I did, and it worked. So that's the first pair on trading. Now the second pair is inversely correlated. So when this pair is going down in price, Euro USD, USD Canadian is going up in price. And as you can see, that back and forth is hedging, but volatility will still play a role. When you do your research for your grids, think about worst case scenario planning. When you're using your demo account, do stupid stuff. Like do what I did. Sell off the asset in your demo account. Does your strategy recover? Does your gridded technique have the resiliency of a worst case approach? Here it does. No liquidations, no margin calls, none of that because of budget management. That is the biggest mistake of any trading system on the market. People don't plan for the worst case situation. Worst case situation is anything and everything can go wrong. A good strategy will recover. A grid trading strategy will recover and flourish. And that is my intended goal with this strategy, for it to flourish. So as you can see, here is the live running program. Small profits continually. Slow and steady, meticulous approaches. And you can see that the amount of time between each check of the market isn't even consistent. It doesn't need to be. That's the beauty of this practice. This is why institutions try so hard to discredit a proper grid trading technique. Because you can make money legitimately. You can make reasonable profitability. You can survive a market, no matter whether it's up or down, with a properly tuned grid strategy. So whenever you see something like this that's so heavily preached against, ask why. Why do institutions not like such a simple and wonderful process? That why is because this will trade in values they can't. This will trade in position sizes they can't. For them, this technique is death by 1,000 profits. So here is, for example, the position size. 600 units is not very much. You're looking at only maybe $10 to $15, $20 at tops. Not a lot of money in this system. And if you're using a smaller account, you might only have $1 or $2 in the system. And it will still profit as long as you set it up properly. Like any trading strategy, your setup, your analysis, and your testing are critical. There is no difference. And even with my mistake, or it would have been a mistake if this was a real market, it made up the losses. It made up literally the amount I lost. What if I didn't take that approach? What would have my profits have been without it? See, those are the kind of questions you have to ask when you look at any trading circumstance. When you look at any real world situation that can go wrong in your trading. This is why you can't use back testing by itself. And this is where grid trading also excels, because you can use a good demo account and see how it would work in a real life situation. That's the point. Research. Study the market. Study the asset you are looking at. As you think about your trading, no matter what technique you use, make sure you do your research. But if you do a grid trading technique, always think about the worst case scenario and be prepared to take a stop loss or 2 or 3 or 13 if the market moves against your favor. Don't buy into the hype that grid trading means no losses. That's not true. That's just a way to get you to lose money rather than actually being able to profit long term from this wonderful technique. So hopefully this will help explain grid trading more, along with showing and featuring the prototype for the version 2 of my grid bot. If you like this video, please give it a thumbs up. Please help me grow my channel. Remember to always do your research. Always think about, why do institutions do what they do? Because they're not your friend. They're not there to help you make money. And they don't care if you lose money. So anything they say about, oh, we're doing this to protect you from yourself. No, they're not. They don't care if you lose your money because they're looking to get it. They're doing whatever they're doing to protect themselves. Grid trading is just one of many viable, legitimate, consistent strategies that you can employ responsibly to give you routine, consistent profitability. If you have any questions, please feel free to ask them. Leave a comment. Thank you for watching, and until next time.